This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. Welcome to the Wealth Roundup for the week of October 22nd, 2025. I'm Terry Evans, along with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Well, let's have a quick look at the markets and see how everybody's dealing with that little bit of volatility we sort of recovered from over the last 5 to 10 business days.
Yeah. So you're right. So just to kind of put some things into context from our last podcast, we had been kind of talking about some of the sell-off in equities, some of the impact for other kind of commodities, investable assets like Bitcoin that had, I think, erupted when the trade talks between the United States and China had gone sideways again. And so that was on about October the 10th. And so, interestingly enough, the podcast before that, we were talking about whether or not clients should be taking profits. So really kind of since that October the 10th sell-off, what we've seen happen is largely the U.S. market has kind of recovered to those levels that it was trading at prior to that sell-off. So that's, kind of an interesting point. The Toronto Stock Exchange modestly down, for the month, nothing kind of extreme. I think it's down to like 0.5 percentage point. So still, relatively good year for the TSX for where we're at. Gold prices set a new all-time high yesterday, but going through a bit of a sell-off today. So actually gold prices are down 5% today, which is pretty significant, but no one's going to whine too much about how their gold has done this year. And then Bitcoin, which we often talk about, also got caught up in that same kind of drawdown on U.S. equities on the 10th. And so it's kind of slowly recovering. I find it interesting that gold and Bitcoin acted a little bit different over the last 2 weeks. And kind of in my head, I'm kind of thinking like Bitcoin is almost like it's like the gold for people under the age of 50. And so probably more leverage maybe in the system with younger investors. So that sell-off in equities impacted Bitcoin more. Gold is probably reflecting the fact that it's already had a really, really good year. So probably some profit taking on that side. But yes, some elevated volatility for sure.
And with that volatility, there's a thing called the VIX. At first, I thought it was Roman numerals, but they're all backwards. You can't make VIX into a Roman numeral, but it's a volatility index. Tell us more about.
Yeah. So every industry loves its acronyms, right? So we've got the Chicago Board of Exchange Volatility Index, right? You got all of the spin all the words. So we just call it the VIX. And when I was thinking about the best way to talk about the VIX, I was thinking about when we're watching a hockey game, so we're watching the Oilers and we're watching, Game 7, and the Oilers are trapped, in their defensive zone, and they just can't seem to get the puck out, right? They can't seem to clear the zone, right? And so you can feel it, as a fan, you're watching this, right? And you're like, get the puck out. You can feel this increased sense of high danger chances that the Oilers are going to give up a goal. Well, I would say that the VIX is kind of like that for the markets. It doesn't necessarily mean that the other team is going to score a goal, but probably what it's saying is that the probability has gone up, or just you need a tool to be able to measure that sense of stress in the market. And so we normally say that a VIX level of 20 or below is relatively normal volatility for the markets. And once the VIX is moving up or surpasses that level of 20 is that we can say, okay, we've got a heightened amount of volatility. So, you were right when you kind of asked the question, it kind of seems like we've gone through a period of volatility. We're right. Well, the VIX actually had gone from a level around 16 up to a level of 18. So that sense of some concerns in the market, not necessarily sure if it was going to lead to another team's goal or lead to a major dip in the market. We did actually see it, that kind of dip in the market on the 10th. But yeah, it's something that tries to quantify what the market is feeling. How it does it is a little bit complicated. It involves options, which are usually forward looking. And so they're looking at what's happening in the options market to determine, how investors are making choices kind of that are based on their, what they see happening in the future. And we have definitely over, probably in around late April, when we saw a big dip due to Liberation Day, again, we would have seen the VIX spike. So when people are talking about the VIX, they're talking just about that way that we're all probably feeling, but trying to quantify it in a number.
A little bit of a roller coaster. Yeah, it's a 16, I think 10 days, 10, 12 days ago, then up to 25, and then back settled down to 18 here for today as we record this. Okay, let's talk about, you wanted to bring up a credit crunch. Are we in a credit crunch, or is this something that's on the horizon?
Yeah, so the reason I wanted to bring up credit crunch is that, so the other interesting thing that was out in the news the last couple of days is a couple of U.S. lenders, names that really aren't all that popular. Tricolors, one of the names, First Brands, one of the other names, and so it was deemed in the courts and the news that these lenders had been kind of fraudulent with some lending, and so they are call them impaired lenders. And so they're going through this process of kind of unwinding some loans. There's probably going to be some bankruptcies, et cetera. And so in the banking system, it's so interconnected. And so if we think back to not all that far back, 2023, one of the banks in the United States, Silicon Valley Bank, at the time, the 16th largest bank in the United States, it ran into serious financial havoc because of some intercompany decisions that they had made, but it created a run on the bank. And so depositors quickly took their money out of the bank, and then they got concerned about other banks. And so again, similar banks to Silicon Valley Bank, people took their money out of that bank. So the banking system is so interconnected that once a run on the bank starts, other banks, they start making decisions where they become more risk adverse. And so what that starts to look like is they make it more difficult for someone to borrow money. So the test by which they apply to say, okay, we're going to lend so-and-so money for a mortgage or so-and-so for a business gets harder and harder and harder to pass that test. So when we see a bank go bankrupt or run into major problems, we worry about the contagion moving through the system as it kind of percolates through the system. And then we also kind of wonder too, is this like a canary in the coal mine? Was this a sign of a greater problem? As you hinted, people just, going out and buying phones. Phones aren't getting any cheaper, right? So people are probably looking for different ways to pay for things. A lot of those things are credit. If they can't access that credit, then they're going to be buying less. And so that, again, that kind of percolates through the system. And so when we use this word credit crunch or credit squeeze, it kind of references, what the banks are doing in the background with regards to their plans and around lending. And so we kind of look at all of these things together at the same time. We see volatility going up a little bit, right? We see inflation going up a little bit. We see, trade war going on. And then we see some issues with the banks. And all these things, when they're kind of happening at the same time, they get investors concerned to say, is the market going to keep going up? Or are we moving into a new phase? And so, I still kind of draw investors back to earnings. A big earnings week next week on the Meg 7. So we'll probably talk about that on next week's podcast a little bit. Happy to go and talk about all these elements and how they work together and how they're interconnected.
The credit crunch, it's a wonderful life. Life imitates art. The savings and loans, George and Mr. Potter and all of the things that go along with that, right?
Yeah, just when we think we fixed everything and it'll never happen again, what's old becomes new.
Yeah. Well, let's hope another angel gets its wings. Where's the bell ringing? The Wealth Roundup for the week of October 22nd, 2025. Thank you very much. Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns.
Thanks, Terry.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.